So the authors are interested to know which performs better, the Fama French three-factor model or the four-factor model, which includes the momentum factor. The three-factor model would be the market coefficient, the size coefficient, as well as the value coefficient. And then for the four-factor model, they add in some momentum. So prior studies have discuss the validity of those two models and explaining security returns. So the authors are planning to compare the three-factor to the four-factor model in the Amman Stock Exchange, which is in Jordan. And this is looking at a period over 1999 to 2010. So they've replicated a study by Fama French back in the 90s where they've created 9 portfolios, and the monthly returns of these portfolios are here in these 9 boxes. And so it's small companies with low book-to-market ratios, which would be indicative of growth stocks, all the way up to big companies with high book-to-market ratios, which would be value companies. And so prior studies have found that smaller companies have higher returns than bigger companies, and value stocks have higher returns than growth stocks. And we see that's still the case here, where small companies have a higher return than big companies, except in this case of high book-to-market ratios. But also, value stocks have higher monthly returns than the growth stocks. So next, the authors formed a regression that has been used in prior studies for the four-factor model. And here we have the 4 factors, the market premium, small minus big, high minus low, and winners minus losers. So this would be the market piece, this is the size, this is the value, and this is the momentum factor. And so using the same time period and same securities, we see that each of the factors is positively related to the returns of the securities under study. But we see down here with the T statistics, we see that the high minus low, the value factor, is actually the only one that is significant at least a 5% level. All of the other T statistics would alert us that the coefficients here are likely not different than 0. So we see that the value factor and the Jordan stock market over the 1999 to 2010 period is significantly explains the returns of the stocks over that period. So the previous table was the 4-factor model, and here the authors are going to analyze the 3-factor model related to the 9 portfolios that we looked at before, which were based on the size as well as the book to market. And so in this first area here, 3 columns I suppose, we have the coefficient values for each of the factors, for instance B1, B2, B3. And over here we have the T statistics of each of those factors. And the authors have put an asterisk next to the coefficients that are statistically significant. So first, as an example to understand this table here, we can look at the small low portfolio. So this would be portfolio with equally weighted small companies, the smallest third of all of the companies in the population, and the ones with the lowest book to market ratio, so those would be the growth companies. And so the alpha, or the intercept here, is negative 0.03 in this equation, and then the first beta, this is the market beta, is 0.69, and the small minus big coefficient is 1.22, and the high minus low coefficient is negative 0.14. So out of each of those coefficients, the market coefficient and the small minus big coefficient are the only ones that were statistically significant. So it's likely that the alpha and the high minus low are actually zero. And so the market and small minus big factors significantly explain the returns in these portfolios. And so more telling of the validity of this model and predicting the returns over this time period for this market would be the R squared, which ranges from 0.18 to 0.83. And so this is would it show what percentage of the variation in the returns is explained by these variables. And we can see the portfolio we just looked at, the small and growth stock portfolio. The R squared is only 0.18, which isn't very high. I would say that the factors that were used doesn't do a very good job of explaining the returns. What we do see here is the big portfolios look like they have the best explanatory value, and that may be because there's more public information about those. And also the factors for the value companies seem to be the regression seems to work better than, for instance, the growth company portfolios. So anyway, looking at the factors and intercepts as a whole, we see that when we use the three-factor model, there's usually not a significant alpha, so that would signal to us that the factors explain most of the variation of the returns. We see that since there's an asterisk next to all of the coefficients here, we can say that the market factor significantly explains the return in all of the portfolios. For small minus big, we see that this factor significantly explains the returns in all the portfolios except the medium-sized portfolios. And the high minus low significantly explains most of the portfolios as well. So we could say that the three-factor model does a pretty good job of explaining the returns in the Amman stock market over the 1999 to 2010 period, especially in large and value companies. So next we're looking at the four-factor model, which is the same analysis as we looked at before, but they've added a fourth factor, the winner minus losers, which is the momentum factor. So the first thing to notice is the alpha factor, the intercept. There is only one significant one, the one with the asterisk. So we could say that the factors in here do a pretty good job of explaining the returns over the period. Otherwise, the alphas would be significant. Also, as we found before, the market beta is all of these are significant in all of the portfolios. The same as before, the small minus big. The medium portfolios aren't significantly explained with the small minus big factor. High minus low is sporadic as it was before. And here we have the fourth factor, the momentum factor. And in this case, the momentum factor doesn't really seem to significantly explain most of the portfolios. We see here that the small and low, small and high, and medium and high portfolios, the momentum factor is significant. However, the others aren't. So we could say that for most of the portfolios, the momentum factor doesn't significantly explain the returns. And looking down here at the R squareds, they seem to be about the same as in the three-factor model. So we would maybe conclude that the four-factor model doesn't add very much explanatory power or predicting power to the returns over this period and in this country.